Welcome to The Explainer. Today, we're going to unpack the real story behind the World Bank's recent decision regarding Kenya's massive emergency loan request. You've probably seen the headlines floating around, right? Well, we're going to look past the noise and find out what's actually happening behind closed doors in Washington. We'll break down the timeline, look at the strict conditions being demanded, and figure out what this bureaucratic holdup means for everyday Kenyans. Okay, let's dive into this. 78 billion Kenyan shillings. That is the massive emergency loan requested by Kenya through the World Bank's Rapid Response Financing option. This facility is specifically designed to cushion countries against sudden, severe global economic shocks. Kenya initiated this request to help manage intense pressure on its economy and keep critical supply chains running smoothly. Section 1, the Kush 78 billion delay. So let's walk through this timeline together. Back in April, Kenya formally applied for this emergency financing. The primary goal was to manage severe fuel and fertilizer price shocks. And these weren't just local issues. They were actually driven by broader global conflicts, including geopolitical tensions involving the US, Israel, and Iran. Fast forward to June 29th, and something really interesting happens. The World Bank actually approves a completely separate 97 billion shilling loan. But then, by July, news breaks that the initial 78 billion emergency request, that one got delayed. Now, you might be wondering, and this timeline definitely sparked a huge public misconception. Was the loan canceled entirely? Because honestly, that's what a lot of the initial chatter suggested. Well, the short answer is no. The status is delayed, not canceled. Basically, the World Bank simply pressed pause. They're acting much like a standard bank that wants to see a really detailed business plan before handing over the cash. Before unlocking emergency funds of this scale, they want granular, clear spending plans from the Kenyan Treasury, proving exactly where and how this capital will be deployed. Section 2. Why did it happen? Now, what's really interesting about this slide is exactly what the World Bank wants to see under its emergency support framework before unlocking the funds. They aren't just handing over a blank check. They require the government to identify specific emergency expenditures. But it goes deeper than that. The lender demands enhanced public financial management, increased transparency and accountability, and proof that Kenya's broader fiscal strategy is genuinely sustainable. It's basically a high-stakes test of the government's commitment to reform. Section 3. Spending cuts over taxes. We've got two distinct fiscal strategies at play here. On one side, you have the World Bank's preferred path, spending cuts. They want Kenya to reduce wasteful expenditure, improve procurement efficiency, and cut unnecessary recurrent costs. On the other side is the alternative path, tax hikes. The lender strongly favors finding room in the budget through efficiency rather than piling more tax burdens and financial pressure on households and businesses that are already feeling the squeeze. To truly understand how strict the World Bank is right now, we have to contrast that delayed 78 billion with this other massive number, 97 billion Kenyan shillings. So the crucial point is that the World Bank isn't opposed to lending to Kenya at all. Remember that June 29th approval? That was a 97 billion shilling package, consisting of both IBRD and IDA funds. But look at what it was for. Governance efforts, financial management, anti-corruption measures, and expanding social protection. They are perfectly willing to release massive funds. They just require strict adherence to governance and reform goals. Section 4. What this means today. Let's move to and see how this builds into a direct chain reaction on the ground. Step 1. The loan is delayed. Step 2. This immediately creates a tightened treasury budget because that expected external financing is missing. Step 3. The government struggles to fund stabilization measures. And Step 4. This translates into immediate pressure on fuel prices. Kenya relies heavily on fuel imports, and without a cash buffer to absorb market shocks, the everyday consumer's experience at the fuel pump starts to feel the squeeze. Without this 78 billion, the government has to literally scramble for alternative options. We're talking about things like increased domestic borrowing, which can crowd out the private sector, doing budget reallocations from other critical services, or desperately seeking alternative concessional loans. It makes fiscal planning an absolute nightmare and could indirectly drive up inflation. And this brilliantly illustrates a key point from our source material. Any strain on public finances can eventually filter through to prices, borrowing, and government support programs. So even if citizens don't feel the impact immediately today, that economic pressure is definitely building up behind the scenes. Which leaves us with this final, incredibly critical question. How will Kenya balance essential public service delivery with debt repayment moving forward?
The delay of the 78 billion shilling loan isn't a final rejection. It's a massive pause, highlighting a core challenge, where the government must prove its commitment to fiscal discipline. The outcome of these ongoing negotiations will literally set the tone for Kenya's economic stability for years to come. Thank you so much for joining me for this explainer, and definitely keep a close eye on how this story develops.